Hi, it's Edward W. Cotney. I specialize in working with high net worth families who are ready to pay less tax for the rest of their lives. I wrote this book to help business owners and individuals begin their journey to pay less tax. Hello, this is Ed Cotney. This is not a chapter from my book, Tax Secrets Made Simple. This is a quick, simple explanation of how to make money giving publicly traded stocks to charity in lieu of cash and profit doing the process. So this is an advanced tax planning structure for people who are making gifts to charitable organizations in excess of $50,000 or more as a current gift. So let's just call this an advanced tax planning strategy, but with some baby steps. The secret to tax mitigation is what we call timing, combining, and sequencing. And when you stop and think about it, that is the way all of these things need to work. There's a proper time, proper sequence, and a proper combination of things that have to happen in the right order. So you have to do things at the right time, at the right place. One of the toughest things we have as a consumer today is the thing called the law of primacy. The law of primacy is basically the law that says when we learn how to do something for the first time, that process remains ingrained in our brain, our psychic, our everything on how to do things, and even how to measure against things we don't know how to do in the future. Just like when somebody teaches you tic-tac-toe and they get rules of tic-tac-toe. So the law of primacy is something that is often good, but in the respect of tax planning, it is often the number one reason why most people overpay their tax, because they've learned how to pay max tax. So we live in a confiscatory tax system. We all understand that as we make money from income, or if we sell a highly appreciated asset with capital gains, estates that transfer subject to death taxes, there's a tax rule. Basically, this is what we can keep, this is what we cannot keep, and the portion that we pay in tax goes to the government charity called the IRS or the U.S. Treasury, which basically is a confiscatory donation. This is how the tax system works, and it works well. When I talk to people around the country, I often hear them say that they're open to a charitable discussion. When we look at some of these statistical things about charitable giving, 60% of the nation is giving to 5 or more charities every year. A good 20% of the nation is strongly philanthropically motivated to give way more than 10 to 15% annually to charity. And then we still have about 20% of the nation that has very little or no charitable receptivity at all. In fact, I've seen people who would not make a donation to a soup kitchen even if their mom was in line. So we do have that element out there, but by and large, the bulk of the nation is charitable giving, and flat out, the United States gives more to charitable organizations than practically all other countries on the planet combined. We are the most philanthropic nation on the planet, period. So I want to kind of bring this thing home. This is where I was raised as a young boy in Mount Carmel Baptist Church in Davie, Alabama. To illustrate where we taught wrong at the beginning, the law of primacy, I'll use my process. In 1965, when I was 5 years old, I used to go to church down at the bottom of this basement down here, and Miss Margaret Keith, God rest her soul, would do a Sunday school lesson for us. And so we'd get to church at 10 o'clock, we'd break up in groups, go to Sunday school, and then toward the end of the Sunday school lesson, Miss Keith would give us a little white envelope. And on that white envelope, we'd write our name and we'd write our donation amount in there. And typically in 1965, it was like a nickel. And if you didn't have a nickel, that's okay. Miss Margaret bought plenty of nickels. Because remember, in 1965, a nickel could get you the big candy bar at the grocery store. So a nickel was a lot of money when you're 5 years old, giving away a big candy bar at church. Then at 11 o'clock, we go up to big church. And at some point, the offering plate comes around. And then we put our white envelope in the offering plate. The question I have is, have we taught the entire nation how to give wrong to charitable organizations? And my argument is yes. We have taught the entire nation how to do this with the least amount of tax efficiency. So let me make my argument. Let's pretend that 5 years ago, you met with your financial advisor. You had $40,000 ready to invest into publicly traded investments. You and your advisor picked out 4 investments, $10,000 apiece. And here we are 5 years later. As we look at the 4 investments 5 years later, one is still worth about $10,000. In other words, it has grown nothing over the last 5 years. One started out pretty good, but kind of plateaued the last 3 years. Notice the picture of the donkey next to it. But it did appreciate, but it's been flatline. The other two stocks have done quite well. In fact, we love those stocks. I call those racehorses. So here we are with some racehorses, a donkey, and a rock in our portfolio. Now, granted, we could sell the rock at any time because there's no gain, therefore there's no gain or losses. So we're just going to sell that stock and buy new stock. But because Uncle Tim told us that any minute now that thing is going to take off, we keep sitting on it. You know, that's a personal decision. You're going to have to really give that one some thought. But look at the lost opportunity over the last 5 years that rock has cost us. I point out the one with $50,000 with the donkey because we've made the decision that we want to give charity $50,000. And because of the law of primacy, we whip out our checkbook because we were taught how to do this when we were 5 years old. We write that check to our church or hospital or charitable organization for $50,000, and we feel real good. When you look at this investment portfolio, notice the $50,000 block of stock. If I give charity the stock or if I give charity the cash, does it matter to the charity? No, because if I give them stock or even real estate, the charity is going to liquidate it, turn it to cash, and then deploy that money to do whatever their mission is. So to the donor, does this matter? Well, here's the tax return. No, don't worry, we're not going to be doing a test on this, but I do want to point out in 2022, the standard deduction for a married couple was basically about $26,000. It goes up a little bit every year. And then I want to point out Schedule A, line 14, which is where we have the charitable gifts. Now, if I'm making a charitable gift of $50,000 of cash or stock or real estate to a charitable organization, this is where that gift would be landing on my tax return. Schedule A, line 14. Cash, stock, gifts to charity goes right here. And since line 14, $50,000 is larger than the standard deduction, it would make sense to claim that as my deduction for the year. And the IRS gives you that choice to claim the deduction if it's higher than your standard deduction. So obviously we want to claim the stock. So if we give the stock or the cash to charity, is there a material difference on the tax returns? Well, I gave cash, that is a basis, therefore it's $50,000. And I'm using round numbers here just to illustrate the process. But here in California, if you're making $1 million a year, you're in the max tax bracket, 37 Fed, 13.3 California. Let's just round it down to 50%. So if I'm $1 million AGI and I give $50,000 cash to charity, technically that reduced my adjusted gross income by $50,000. It also reduced my tax bill from $500,000 down to $475,000. Again, just using round numbers to simplify this thing. What I'm trying to illustrate here is that I gave $50,000 of cash, which was my basis, to charity, and it earned me $25,000 of tax savings. Just to make certain we're clear, I gave $50,000 to charity, and it bought me $25,000 of actual tax savings. If I give the highly appreciated stock, the donkeys, that have been basically poorly performing over the last 3 years to charity, that has a basis of $10,000, I still get the fair market value tax deduction because I'm giving to a public charitable organization. I'm in the same tax rate, and it still bought me $25,000 of tax savings on the form. This is where I'm trying to get you to stretch, trying to get you to think past the number that's on the form. On the form, $50,000 is the same on Schedule A, line 14, as it is transposed over to the 1040. It is the same tax savings, but there's one major difference between these two gifts. Notice the basis line. The basis line on my stock is only $10,000. That's money that I have in that investment. Remember, basis is my after-tax dollar. Notice my tax savings is $25,000. That's the difference. Here, $10,000, even though it is valued currently at $50,000, the actual money in that stock is only 10 grand out of my pocket. So that $10,000 gift created a $50,000 gift for the charity of my choice and it still bought me the same tax savings, but the net difference between my basis and the tax savings is a $15,000 profit. For those of you who are scratching your heads, yes, now's the time you back the video up. By giving stock that has a basis that's less than my net tax savings, it is a profit. And this is where people in the audience, when I teach this all over the country, just have to stop for a minute. Multiple times they'll ask me to back up and start this part of the presentation all over, but you've got the video, watch it as many times as you like, send it to the most expensive tax attorney you can afford, send it to the most expensive CPA you can find. Walk them through this process. If you've made the decision to give a gift that's higher than your standard deduction, and if you have an investment portfolio or a real estate portfolio where you have highly appreciated assets that have become poorly performing, and that appreciation is greater than your basis and it's greater than your standard deduction, you have to step back for a moment and ask the question, should I give a check or should I give an appreciated asset such that I can get a double tax benefit? This is amazing stuff, and I call this charitable tax harvesting. Many of you get taught by the financial planning industry how to do tax loss harvesting when you have an investment portfolio that's got poorly performing assets and you liquidate and move them around. So what I've been able to demonstrate in just a few slides is one of the secrets to tax mitigation using timing, combining, and sequencing. Can we give highly appreciated assets to charity and get a double tax benefit? Yes. Should you do it? This is where you need to have a conversation with your CPA and your attorney and your financial planner to have this discussion. What is the most effective way? I will tell you from the experiences that I've had over the years is that the most effective way to do this is when you've made the decision to make a donation of say $50,000 to your favorite charity. Take your checkbook, go meet with the financial planner, identify $50,000 of highly appreciated, poorly performing stock, give that financial planner a check for $50,000 to buy new stock so that hopefully they'll turn into racehorses. Donate the donkeys to the charities of your choice. Now, the charity does have to have a brokerage account to receive the transfer. This is something your financial planner can help the charity with if necessary. Transfer out the poorly performing assets to the charity of your choice. Get the same double tax benefit I showed you here. And now your new $50,000 has a new basis that hopefully is going to give you a better performance long term. Charitable tax harvesting is a fantastic tax secret that everyone needs to consider if they're making gifts greater than their standard deduction each year. If you have any questions, feel free to give me a call. I hope this message has inspired you to learn how to pay less tax and enjoy more life. In my videos, I share insights into how to utilize the most generous tax code on the planet, courtesy of the Internal Revenue Service. Please like this video and subscribe to my channel. Visit my website, olympustax.com, to buy my book or contact me. Only you can exercise your right to pay the least amount of tax due. Watch for the next video covering another topic from my book, Tax Secrets Made Simple.